Hey everyone, welcome to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that is absolutely foundational for anyone looking to start trading in the Forex markets. This episode is called Forex Fundamentals, Mastering Currency Pairs and Pips. If you're a beginner, this is your launch pad. We're covering the absolute basics in full detail. Currency pairs, how to read Forex quotes, what a pip is, how leverage works, and why risk management is the backbone of smart trading. Whether you're in Lagos, London, Lahore, or Los Angeles, this is for you. So grab your coffee or your notepad and let's get into it. Let's start with the basics. What is Forex trading? Forex, short for foreign exchange, is the global marketplace for buying and selling currencies. It runs 24 hours a day, 5 days a week, and it's the largest financial market in the world. We're talking over $7 trillion traded daily. Yes, you heard that right. And participants range from major banks and hedge funds to governments, corporations, and yes, individual traders like you and me. Now, the goal in Forex trading is pretty straightforward. You're trying to exchange one currency for another at the right moment so that the change in value works in your favor. If you buy a currency pair and the base currency strengthens, you profit. If you sell a pair and the base currency weakens, you also profit. But make no mistake, this market isn't like buying and holding a stock. It's fast moving and usually involves much higher leverage. Now let's talk about currency pairs, because in Forex, you never buy just one currency. You trade pairs. One currency is being bought and the other is being sold. Take this example, euro to US dollar. The euro is the base currency. The USD or US dollar is the quote currency. If euro to US dollar is quoted at 1.1000, that means 1 euro is worth 1.10 US dollars. If you buy this pair, you are buying euros while selling dollars. If you sell the pair, you are selling euros and buying dollars. It always works in twos. Understanding the structure of these pairs is crucial because your entire trading strategy will depend on how these values fluctuate against each other. All right, now let's decode how Forex quotes work. Every Forex quote has two prices, the bid and the ask. The bid is the price at which the broker is willing to buy the base currency from you. The ask is the price at which the broker is willing to sell you the base currency. Let's say euro to US dollar is quoted as 1.1000/1.1003. 1.1000 is the bid. 1.1003 is the ask. The difference? That's the spread, which in this case is 0.0003 or 3 pips. That spread is how brokers make money. Spreads tend to be narrower in high volume pairs like euro to US dollar and wider in exotic pairs. They can also expand dramatically during low liquidity or high volatility periods, especially around economic news releases. Speaking of pips, let's break down what a pip is. A pip stands for a percentage in point, and it's the standard unit for measuring how much a currency pair has moved. For most pairs, 1 pip equals 0.0001. For pairs involving the Japanese yen, like US dollar to Japanese yen, 1 pip equals 0.01. So, if euro to US dollar moves from 1.1000 to 1.1005, that's a 5 pip move. Simple, right? Now here's why pips matter. They help you calculate profits, losses, and where to place your stop loss or take profit orders. Say you're trading one standard lot, which is 100,000 units. Each pip is worth $10. So if euro to US dollar moves 50 pips in your favor, you've just made $500, but it works both ways, so without proper risk management, you could lose that too. Next up, types of currency pairs. You've got 3 categories. Major pairs. These include the US dollar and are the most liquid. Euro to US dollar. Pound sterling to US dollar. US dollar to Japanese yen. US dollar to Swiss franc. Cross pairs. No US dollar involved, but still liquid. Euro to pound sterling, euro to Japanese yen, AUD/NZD. Exotic pairs, these pair major with a currency from a smaller or developing economy. USD/TRY, Turkish lira, Euro/ZAR, South African Rand. Exotics can be tempting due to bigger price swings, but they come with wider spreads and lower liquidity. If you're a beginner, stick to the majors. Let's talk leverage. This is where a lot of new traders either get excited or get burned. Leverage lets you control a big position with a small amount of capital. With 100:1 leverage, you can control $10,000 with just $100. But don't be fooled, this can go sideways fast. Say you open a $10,000 trade with $100 in your account. If the market moves 100 pips against you, you're down $1,000. But wait, you only had $100 in there. You're wiped out and possibly in debt to your broker. That's why it's critical to understand how Forex leverage works and to respect it. Use it wisely and always tie it to good risk management practices. Which brings us to Forex risk management. Golden rule. Never risk more than 1 to 2% of your capital on a single trade. Always set a stop loss before you even enter the market. And use take profit levels to lock in your gains. You should also use trailing stops to ride profitable trades. Stick to a risk-reward ratio of at least 1 to 2. Calculate your position size properly using a calculator or tool. Without this, you're basically gambling. Even the best trading strategy will fail without solid risk control. Now let's talk about timing. When is the best time to trade Forex? Forex runs 24/5, but the market is most active when major sessions overlap. London session, 3 a.m. to 12 p.m. Eastern Standard Time. New York session, 8 a.m. to 5 p.m. Eastern Standard Time. The overlap between London and New York is where the magic happens. If you're in Asia, the Tokyo session from 7 p.m. to 4 a.m. Eastern Standard Time could suit you. Volume spikes during overlaps. That means more liquidity, tighter spreads, and more trading opportunities. If you're wondering about the best time to trade Forex in your region, do a quick search based on your time zone and lifestyle. Let's not forget news trading. Big events move the market. High-impact news includes non-farm payrolls, NFP, interest rate decisions, inflation numbers like CPI, GDP data. If you're just starting out, don't trade around these events. Price can whip around wildly. If you do trade news, use tight stops or stay on the sidelines until things settle. Eventually, you can develop Forex strategies for beginners that blend news awareness with technical setups. If all of this feels overwhelming, don't worry. You can learn as you go. Check out crystalballmarkets.com. It's a beginner-friendly Forex trading platform with everything you need to get started. Sign up for a free demo or real account and start exploring the markets. Prefer audio learning? You're in the right place. And for more in-depth trading insights, check out the Crystal Ball Markets Forex podcast for weekly strategy breakdowns, news discussions, and more. Before we wrap up, here are some final tips for beginners. Start with a demo account to practice. Focus on just 1 or 2 pairs. Keep a trading journal to track your decisions. Don't chase losses or trade on emotion. Stay hungry to learn and evolve with the market. All right, traders, that's a wrap on today's episode. If you now understand what a pip is, how to read a Forex quote, what currency pairs mean, and why risk management matters, you're officially on the right track. Remember, Forex trading isn't about luck. It's a skill you build over time. Be sure to check out crystalballmarkets.com and subscribe to their podcast for deeper learning. I'm Sophia, and this has been Financial Market Insights for Traders. Catch you in the next episode, and as always, trade smart.